Hello everyone, welcome to the second session of Agni's Facebook Live session, and today's session is going to be on fundraising. Going to take a couple of minutes to introduce Agni to you. Agni stands for Accelerating Growth of New India's Innovations. It's the National Technology Commercialization Program under the Office of the Principal Scientific Advisor. So we essentially act as the bridge between the innovators and the industry. While Agni is not a funding organization, many of you have sent us queries regarding funding, what the process is like, what kind of funds exist. So we thought that today's session should be on fundraising. And to lead the session, we have with us Mr. Arpit Agarwal here.
Hi, everyone.
So Arpit is the principal at Bloom Ventures. Bloom Ventures is one of India's leading early stage venture capital firms. And Arpit leads the healthcare and the deep tech sectors at Bloom Ventures. He has also been promoting startups and working very closely with startups for over a decade now. So we really do hope that we can answer all your questions here, and handing over to Arpit now.
Super. Thank you. Thank you, Pooja, and thank you, Agni, for giving me this opportunity to share what I've learned about startups with all you guys. It is a privilege to be here, and I'm hoping this session is of value to most of you who are sitting and listening to us. I'll just start with a brief background about myself. And as you can see on the screen, we are talking about how does an average scientific startup approach venture capital in India. Just to give you a brief background, I have been part of this organization called Head Start Network for last about 12 years. I'm a co-founder. We are one of the best known early stage and grassroots innovation support and entrepreneurship support organization. It is a community of entrepreneurs been running in about 23 cities across India for last 12 years. We do these monthly events called Startup Saturdays. I've also been part of an early stage venture capital firm called Bloom Ventures for last about 5 years, where my primary responsibility is to look at new innovations and also help them with growth funding and funding through their lifespan towards an exit. We are hoping to create a very big ecosystem out here between Head Start and Bloom. Of course, when I first interacted with startups all the way back in 2007-8, it was a very small, ecosystem. People did not know about startups and no one was talking about it. At this point, a whole bunch of people have now got on the bandwagon, and people are, it is very common to hear about startups. One of our interns was recently doing a research report where he found that there are more than 100 plus accelerators in India, mostly focused on a variety of technology and technology businesses, and unfortunately most of them are based in the big cities like Bangalore or Bombay or Delhi. However, some of them are emerging in smaller towns. This wasn't the case all the way back in 2005, 2007 when we started Head Start. So I've also been part of, I started up a company called Academic Ventures, which was into commercialization of technology. This was in November of 2010. The whole idea behind it was to help some of you guys try to commercialize technology and help you figure out what all you need to do to make sure that the research that happens on public money finds its way to the market in average people's hands. Unfortunately, that business did not take off for me. So I'm also a failed entrepreneur thereof. And I then joined back a corporate job. That's about myself. What I'm going to do here is to break my my talk into a few broad sections. First of all, we'll talk about startups. First of all, we'll talk about venture capital ecosystem. What is funding? And just to make sure that every one of us is on the same page and we are talking about the same thing with the same terms. And then we will talk about how can an average startup approach an investor. And then we will talk about various aspects like valuation. These are some of the questions that all of you guys have asked Agni team. And we will talk about some of those, about funding schemes and valuation, and so many other topics are, basically all the basic questions about startups, which are very common in India today. So just going back to my slide presentation here, if you can, as you can see, basically I just want to give you a background about what Bloom Ventures is, so that all of you know what we do. We are an India-based and India-focused venture capital fund. Our experience has been that we want to build startup funding at a very high amount of scale. Therefore, we started building this fund structure, which allowed us to invest at very high amount of scale. We have also not shied away from investing in science-led startups. Almost 10% of our portfolio has a very strong IP element, and we are one of those few people in the venture capital community in India who firmly believes that all of us can do a better job than one of us, and therefore we have built a platform approach to VC business in India. Or in terms of some numbers, we today manage about $200 million of assets under management. This is all private money. I will talk about how fund business works in a brief while. And among the founders and entrepreneurs in India, we have a very friendly image. A lot of people find it easy to approach to us, and therefore a lot of people want to work with us over a period of time to be their partners in the long-term journey of building a startup. That's about Bloom. Let's change gears and talk about what is funding landscape in India. Funding landscape in India can be broadly broken down. Funding is an ever-growing need for every startup. When the businesses keep growing, a whole bunch of funding is required for that business. The core part of the business, as you can imagine, the first bit of money that anyone gets to invest in comes from your own self. So, which is where we are talking about self, spouse, and family funding, where very small amount of funding which you can pull out from your own savings. Let's say about 10 lakh rupees can be put together, maybe 25 lakhs in some cases, can be put together from your own core, yourself and your spouse, and then quickly followed by, let's say, a friends and family around, where you can, they know you, they have seen you executing. They also do not have a very, it's very interesting to note that the relationship that we are talking here starts becoming from most friendly to most professional. If you can notice from top to bottom, you obviously know yourself better, so your involvement is going to be very high, and your hope of return is very high. At the same time, you have no way that you can put any objective measure around it, and you therefore put in whatever the best you think you need to do. At the same time, the friends and family have definitely some expectation of return. However, they also play because they love you, and to some extent, if they don't get their money back, there is a relationship which is at stake here. Although they definitely understand that the risk is much higher because it's very early stage, expectations are higher. When the company needs a slightly larger amount of capital, that capital is typically provided by people who are super angels or professional angels. Now, this is an interesting category of people. These people typically belong to the world that like VCs live in. They have either been entrepreneurs in past or are running successful businesses, and it typically takes a lot of time and energy to close these rounds. It very often takes sometimes between 3 and 6 months to close a round of, let's say, 1 to 2 crores, which is raised from angels. However, these people, because they bring a lot of network, they are directly very helpful and are willing to help the company grow over a longer period of time. After you have exhausted this limit, you go to what we call as venture capital funds. Obviously, as you can imagine, this is more organized way of looking at startup funding, and therefore it becomes much harder for anyone to access this funding. But because of the nature of this business, we as venture capitalists are much more capable of helping companies at scale. Also, we also make sure that because we are answerable to our own investors, we are applying much tighter filters. To that extent, if a venture capitalist has funded a company, it can also it is sometimes seen by the market as validation of someone who understands the business backing you up. So this is broadly what it is. Now, some of you obviously have questions around it, but I want to bring your attention to an important part, which is to see that, as you can see, from self all the way to VCs, there is there's a trend, and please notice this trend. One trend is that these are most friendly, or relationship is strongest, down to relationship is most professional. I won't call it weak relationships, because part of our business also becomes very friendly with the entrepreneurs we are funding. The second part is that they are the expectation of return goes much higher, and willingness to take risk goes also much lower. You would expect VCs to take a lot of risk, but typically VCs take less risk than you do. So if you are not willing to take risk, or often that is a reason why you will not be able to raise money from VCs. So we typically prefer companies where entrepreneurs have put a lot of effort of their own and potentially maxed out on their own finances before they have even tried to come to an average investor who's a professional investor at that. Now, the most obvious question then is to ask about what would I look like? What is the valuation that these investors are going to give me over my lifetime? So there is a table out here. This table is proprietary. This is basis what we have discovered over last 6-7 years of our existence as Bloom Ventures. We are basically putting together a set of it's just a framework to think about how our business works. Is that, and I should take up some segue here. So there is no real science behind valuation at very early stage of startups. You can imagine that we really have no clue. There is no real method in the business to figure out what is the right way of valuing a startup. Effectively, we resort to the simplistic definition of the market is the right determinant. So whenever we are looking at funding whenever you're looking at funding a company, we basically give them what we think is our market willing to give the same kind of company. So for example, there may be a very early stage biotech venture which has no revenue, but it is not uncommon for that venture to get, let us say, a valuation of 20 crores or 30 crores, because the IP that has gotten built in the process is so much stronger that we can all together take a view that this is valuable up to the range of $3 to $4 million, which is 20 to 30 crores. While in some cases, if you are building a consumer brand for the same 3 to 4 year journey, the valuation may actually not be so high, especially if you are not raised more money in past, and especially if the growth is not going to be very high. However, a biotech venture, even at 20 to 30 crores, may actually fail because there is a very high amount of risk in build. However, the consumer brand business, because it has survived for 3-4 years, will probably continue to survive for a really long time. And from the perspective of an entrepreneur, it doesn't really matter what the valuation is, as long as the business is surviving and is doing quite well. So how do you arrive at valuation? You basically arrive at valuation by looking at whatever the market is willing to give to each startup. Imagine a startup being, let's say, valued at 20 million. How do I arrive at the value of 20 crores? I arrive at it by saying, okay, I asked around my peers and find out what are they willing to give. And over a period of time, I have a good sense of what they will be willing to give. So it's basically between two parties who are looking to give you a value. It is not very different from you going out to the market and searching for a job, where your value in the market is determined by what people are willing to give you, and not determined by what you think your value is. So it's not very different from it. It's market determined, and therefore in Indian ecosystem, this is what looks like. At a seed stage, it is common for a startup to get valuation between 5 crores to 10 crores. While in a early product market fit angel round, the value typically increases from 5 to 10 crore to about 10 to 15 crores. as you can work the number math around. Another interesting point to note here is that at every point of time when a startup is looking at getting valued, the investor is rarely looking at valuation per se. Investors is mostly looking at what kind of stake do I want, and what kind of money does the startup want, and you put them together and you get this valuation. So valuation per se is a derived quantity. Now, I'm not sure if this is well understood. I've also written 2 blog posts. I suggest you go and read. The blog posts are titled "How do we value your startup?" And you will get a little more background of the same information. Again, I do not have a right metric in terms of IP and science-led startup here, and you have to simply use B2B SaaS companies as a proxy of this value. However, because you have an IP-led startup, it is not uncommon to see the valuations being ahead of what I'm putting out here. But since IP is varied, it is very difficult to put them in a simple structure as I have already done in this table. Let's move on. Let's talk about how do you basically access more amount of investment. And before that, let's talk about who are the various kind of funding and startup support agencies. And obviously, we are not talking about Agni here. Agni is already doing a good job. There is also Startup India, which has a variety of programs. There are organizations like Head Start that we run in so many cities, and there are so many others who are today very happy to help startups wherever they are. At a very early stage in your journey, you obviously have to go to an incubator or accelerator. Now, by virtue of them being based in an academic institution, they also have access to expertise in science. Also, they may have access to certain laboratories, which make the cost of building your product much smaller. So if you go to a venture center in Pune or a sign in IIT Bombay, you will probably get access to the whole bunch of infrastructure that these institutions have set up over their lifetime, which is very valuable because for a startup, all these machines are very costly, and you wouldn't want to invest all their hard-earned money into buying machines, even without getting access to the customer. Of course, when you grow up, you will buy all those machines and you will be able to afford all of that. But it helps to go to these institutions. For those of you who do not know it, C-Camp is more biotech oriented, while Sign is very broad. Venture Center is also much broader, but they typically don't do software-led businesses. They don't incubate software-led businesses. They are more focused on energy, clean tech, and biotech. At the same time, IIT Delhi FIDT is also as wide as Sign. CIIE is part of IIM Ahmedabad, and NSRCL is part of IIM Bangalore. Both of them are not so known for core tech innovation. So just when all of the incubators have different flavors. The interesting thing which is happening in India is that today there are, as I mentioned earlier, more than 100 accelerators in the private sector, and there are certain accelerators in the government sector also, which allow a large number of people to access funding without sometimes even diluting any money, because they are part of a larger group, and sometimes they have access to certain grants, sometimes they have access to certain expertise, and so on, which makes it very interesting as a proposition. For the corporate, they get access to the innovation, and for the startup, they get access to the corporate, both in terms of funding, also in terms of market access. It's a win-win relationship. Unfortunately, I do not see much of that happening in tier 2 of India. Mostly it is concentrated in our big cities like Bangalore or Delhi. And I would really wish more and more should happen. Hopefully over next 2 to 3 years, more accelerators will emerge in smaller towns. The second part, where you can get funding are obviously government agencies. DBT and BIRAC, in my mind, have done an excellent job of promoting scientific innovation in biotech. Basically, these companies, DBT and BIRAC, are both focused on biotechnology, and biotechnology is indeed the hardest to grow the business in. Therefore, over the last about 6-7 years, they have funded more than 500 different biotech companies, which is a great thing. Otherwise, we wouldn't have a lot of biotech companies going around. There's also Department of Science and Technology, and Department of Internal Trade, which has this fund of funds scheme, through which some of the venture capital funds like ours are also able to raise money, which eventually we give you. At the next step, you will have to go to networks of angels. There are these angel networks which are very famous. There is Indian Angel Network, there is Mumbai Angels. Almost every large city in India, Hyderabad, Calcutta, Ahmedabad, Jaipur, I've heard Indore, Lucknow, have some angel networks. So my suggestion is, wherever you are, please look for a nearby angel network and please go to them. They also, being by virtue of being part of this giant ecosystem that we have, they also have very good access to bigger angels and also VCs. So that becomes a good conduit for us to also look at startups as and when you mature up. The next obviously are VCs. Now VCs in my mind come in two flavor. You should definitely look at VCs not only from the perspective of us funding larger companies, but please look at us for example, Bloom is one example where you should look at us as seed stage VCs. We are typically seed and pre-series A stage VCs where we do not wait for you to have accomplished what is called as product market fit, and you can then arrive at our doorstep, and we'll probably look at you. At the same time, there are certain later stage VCs. There is a CEF Partners, there is a Kalari, there is a Nexus, there is Sequoia and Excel Partners, and so on, who are also doing a very good job. Some of them do fund. I know that there is a fund called Sequoia Capital, which does fund a lot of healthcare investments and biotech investments. I know that Stellaris is looking for electric vehicle startups. I know that Nexus is very happy to do software and artificial intelligence kind of investments. And Venture East is based in Chennai and Hyderabad, and they have a very core expertise in looking at science-led companies. Just to go back into the previous slide, and as you can notice, I have broadly mapped all of these 5 stages into the 5 set of different investors, and you can take a look at all of them and say wherever you want to approach and how does it really work out for you. Okay, so let's take let's go to the next level and talk about what kind of startups VC like. Now, this is a question that a lot of people also ask, and that has been asked to the Agni team also before they were looking at doing this kind of a session. There's a question where you're talking about where some people asked, what are the prerequisite before a startup can get any funding? Now, there is no really prerequisite to get any funding. Of course, what VCs typically want is that they, as you can imagine, we do not have our own money. Therefore, because we do not have our own money, we end up making investments basis whatever a mandate our investors give to us. And therefore, our ability to, write checks is limited only to the extent what the investors have allowed us to do or not do, right? So with that background, let me just tell you what VCs are looking for in a startup. So a lot of you may not be aware of this, so I will not dwell too much time because this is not completely relevant, but definitely helps to set the context. Basically, what we are looking to do, and you can look at it, you can go back and check. Basically, if we are a 100 crore fund, like Bloom's Fund 1 was about a 100 crore fund, this fund is raised only from very wealthy people, and it was raised only from Indians. It is also, as you can imagine, because the underlying asset class is probably the highest risk asset class, it is very difficult to raise this kind of money from anyone in the country. And our target is to actually deliver much better returns than you would expect from any mutual fund or an FD. We are talking about 3x to 4x returns in 8 to 10 years, which obviously is a very high ask, right? Now, how do we make our money? How do we keep ourselves running? Is by taking what is called as management fee. So we take a bit of management fee away from you, from an investor per year, and we invest into companies like yours. Now, it is also important to know that we also, as individuals, as people who are managing this asset, we end up making a lot more money when we make a profit for our investors. So about 20% profit share is given out to all of us as managers if the targets are met. Now, obviously, you can imagine that, just by investing, we are not quote unquote making money. The making money bit will happen only when exits start to happen. So the best exits, in some sense, give you at least 50 to 100x of the amount that we invested, and hopefully that amount is as big as the fund itself. So some of the best performing companies will actually be able to deliver about the same 100 crores that got raised by just one investment. That is the kind of asset class that we want to invest in. Obviously, this is not easy, given that some of the businesses will actually return such a high amount of money, but this is not easy to get done in a short span of about 8 to 10 years. Therefore, a lot of businesses do not fit into our thesis, and therefore, it is this is statistic coming from abroad, where only about 2% of the businesses ever raise this venture capital money. So it is naturally relevant for industry which can deliver a very high amount of growth, and by design this works for most companies who are very small in nature. And because we act in a very data absent kind of a situation, we have very narrow focus at times, and we often get swayed by what is called as a trend. So you can see that at some point of time, a lot of companies like Swiggy or Zomato got funded. That is only because a lot of people together thought this is a great idea. Some other companies abroad have gotten funding, so maybe we should look at similar ventures in India. Not always a good idea, but because this investment tends to be more subjective in nature, it ends up being like that. So naturally, software is a good fit, and you can see that when you're doing a software business, it is much easier for venture capital companies to fund a software business, because it is so much cheaper to do a software thing. For example, there is no cost of building a website. There is almost no cost other than your time to build an app. There's almost no cost to write a piece of software, because there is no cost of the tools that are required to build the software, or in fact there are free services which allow you to run the software for a long time for free. Now, because there's almost no cost, a lot more companies, a lot more people are able to build a software company, and a company which is focused on the internet and mobile technology, and not focused on solving the big problems in this country, like for example like solving the malaria problem, or the TB problem, or building a new drug for cancer. Those kind of things are obviously harder, and it becomes very hard for anyone to start unless they have some expertise in the science that is involved. Therefore, I mean, obviously, there's a disadvantage to that extent of companies which are science-led when they start raising money, because you always get compared with other companies which are little bit more in demand. Some people call this sexier, and they are basically looking at uh, much faster return. So yes, I mean, if, for example, if you are a biotech company, for example, you will definitely need an MTech, if not PhD, to even start thinking of any good science. The infrastructure cost is going to be high. The time that you require is going to be high. Your customer acquisition is going to be very limited, and it is going to take a painfully long period of time. And most investors that you will meet, unfortunately, will not understand what you are doing, because this is not something that most investors invest in. It's inherently very hard, right? I mean, therefore, it is very obvious, if you look at it from this perspective, that most VC, especially in India, care a lot more about software companies or ICT companies broadly, as compared to companies which are doing pure science, because pure science is so hard, right? So how do you then approach VC funding? And this is the last bit of my presentation. I do not have a sure short answer, and I don't think it is fair to have any single formula, because it is to expect any single formula. It is just going to be very subjective as to when and how a startup is going to get funded, but let me just try attempting some method by which you will be able to accomplish your funding requirement. You have to understand this. So I'm calling this process as investor development process. I'm just taking what is very famously called as customer development, and I'm basically putting it around as investor development. What is customer development process? Customer development process means that a startup founder has to be very focused about the business versus very focused about the product. A lot of people that we have met as Bloom Ventures end up doing very good, well engineered products. Unfortunately, these products don't go to the market, and what ends up happening is that whatever their potential and the IP involved is, people just do not uh, are not able to build it in a business setting. They are not able to wrap it around in a very fast growing business environment. As a result, what ends up happening is that despite the best intentions and innovations, you end up not being able to find customers or investors. So in my mind, as long as you have investors, as long as you have customers, investors are bound to come. So what you cannot, but what you probably not won't have access to is investor market. But at the same time, you would have access to some customers. You should focus on delighting your customers, and as long as that is happening, investors will find you sooner or later, right? It is also important to take feedback from for everything that you're creating. You have to also understand that not everyone will understand your business, and if some people really do understand your business, they're making an effort to understand your business, by all means keep engaged in that person. Make sure that this person is well updated about what you're doing. Make sure that you are in touch with them, at the same time taking enough feedback from this person who's in the venture capital community and saying, okay, I like your business enough. It may be early or it may not be right for them, but you have to give them some degree of comfort by establishing a longer term relationship. Sometimes this can take 6 to 12 months before you are able to raise money, and which is fine. Another thing that I think helps and has helped most number of founders is that you need to know that, as I mentioned in this slide, you need to know that our business is about very narrow kind of funding. We are being paid, and we think it is in our best interest to have a very narrow view about every business. Therefore, it is common for us to reject almost 99% of companies that come our way. So please do not attach, please do not attach the fact that if an investor is not taking interest in your business, it is fundamentally a bad business, because it is not. I mean, as long as you are serving some customers, there is a value that you're able to build. It is not a bad business just because an investor is saying that we do not want to fund it. Be very careful. I think it's important for people to know that it is not going to be the most important thing. Uh, Another thing is that you have to also understand that we are also people who are learning. We are not very core experts in every kind of science, and we kept getting thrown into middle of multiple things which we don't think we understand so well. So it will definitely help, as I'm mentioning, that you please educate us, tell us more about our business, help us build some comfort. And as long as you're doing that, I think we can talk, and there will be the funding path becomes a lot more easier. That is my view. Very quickly, I'll run through some of the challenges that you are facing and how can you help solve those challenges and eventually be able to secure funding. One is that you want to make sure that you have an amazing access to talent. You have a very good reputation such that the best talent wants to work with you. Second is you have to also make sure that your infrastructure cost for all kind of science that you're doing is much minimal. If you're having a limited infrastructure cost, it makes the business much more scalable, and more importantly, it survives for long term without access to a lot of capital. Uh, you should also think about how quickly do you want to launch in the market. See, it is not always possible to shorten the cycle, but my suggestion to you is please take a lot of please make sure that you are talking about bare minimum features. One book that I would like to recommend to all of you is a book written by Eric Ries. This book is titled The Lean Startup. So you should read that book. Even if you're doing a science startup, it was very useful because it allows you to focus on what matters most, which is the customer and the feedback that the customer is willing to give you and all the analysis around it. It's a very, it's a very easy read. You should be able to cover most of it about 2 hours. So by all means, please go ahead and read that book. While doing this, you should always ask yourself these questions. What are the is there any better method to do the same thing that I'm doing? What is the right, who are the best people in this field, and what all can they do? I mean, is it not possible to shorten the cycle? For example, you can meet more customers, you can ask and find out more about the business models. Also, sometimes the solution lies in simply obviating what is the biggest roadblock in some cases, which is the regulatory pathways. So a lot of startups which have become successful have taken access to an easier regulatory route, which saves at least 1 to 2 years of your lifespan, and you can hit the market faster. It is a great idea. So the point I'm making is there are a lot more creative things which are possible than what you think you may be doing, and it may be a good idea to therefore work like. For example, you can reach out and work with a large pharma company if you're a biotech company. That allows you to get instant access to very good talent, good validation, and more importantly, like all large companies, they will have access to a lot of they have access to the market. They can take you to doctors or to diagnostic labs or to whoever else is interested, which save a lot of time for you. And by all means, it is a win-win relationship. The fourth thing is to acquire customers. I mean, it's a no-brainer. You have to do whatever you need to do to acquire the customers. The fifth is be patient. I think the gist of this slide is that you have to be very, very patient with whatever you may be doing. As Bloom Ventures, we have a keen interest in funding science-led startups, but sometimes we may not understand it enough. Please be patient. Please help us understand. We are not the smartest people in this world, and therefore, and also not the most informed people in this world. So it'll be nice to know from you and learn from you what all we can do better. And as long as someone is willing to learn, please go and inform this person about what you have built, and we would love to learn and know more from you. That's all from me. This is all that I wanted to say with all of you. We can of course discuss a few questions that have come up in the comments. So there's a question that someone has asked. I'm so sorry, I don't have the name of this person, where you're talking about that you have a certain number of customers ready and you want to now launch it out in the market and therefore raise money. So it's great that you have customers ready, and it's great that you want to go out in the market and raise more money. It is a fabulous idea. By all means, please go ahead and talk to more investors. I do not know what status, what is the kind of level of this, what is the maturity of your business. I'm sure this is doing quite well. Please go and also talk to more investors. It is very difficult to say based on the information that we have as to who are the right people, but try reaching out to certain angels. What has also helped a lot of people is that if you find out that some startup in your area has recently been funded, you should try reaching out to the same set of people who have funded this company, because even if they are not going to fund you, they will have definitely a much better understanding about the business, and they will be able to help you connect to more such people. There's a question that Sachin Vashne has asked, where he is saying that they have a project is ready and what kind of preparation is required to go to the market. See, Sachin, there is no preparation that is required to go to the market. Please try and approaching everyone that you can. Even if you are not ready, it is fine. People will help you. This process is going to help you get better and understand your own startup much better. So please go ahead and do what you need to do, but make sure that you're talking to more and more investors. Don't wait. There is no prerequisite. It is a completely private industry. There is no license or no eligibility criteria. If you find someone who likes you, they will probably also be able to fund. These are the two questions that have come up. Okay, so this Vipul is asking whether this presentation can be shared. Uh, we will figure out a right way of sharing this presentation with you on this Facebook page, and you can then take it up. And of course, feel free to reach out to me, and we will be able to help you whichever best way we can. Of course, Agni team is out here only for this, only for all this facilitation. It is much better to reach out to these people because they are more connected to all the kind of people and just not me. So yeah, that's what it is.
Thank you. So thank you, Arpit, for such an insightful discussion, and we really do hope that your queries have been answered and you have more insights about the funding process. Going forward, many of you have asked us to share the presentation. So what we'll do is we'll put it in the comment section below. We'll attach the presentation and you guys can go through the slides accordingly. I believe there are more questions that Arpit can answer.
Sure. So guys, more questions. Thanks, Pooja. Giridhar Raju is asking, what is your opinion what is my opinion on EVs? On EV startup suitability for VCs in India is being hardware and big OEMs will wait it out. See, electric vehicles is a very interesting area. I also wrote an article last year in May about what is of interest to us. And I know at least one venture capitalist, his name is Alok, he works with a firm called Stellaris Venture Partners, has openly expressed interest in talking to EV startup, which is great. Please go out and reach out to them. I don't know what they essentially want to do, but both of us are interested in talking to more companies.
Any other questions?
Yeah, so there's one question. So another question is, investors only say yes to startups with market traction. How do you get startups to a marketable prototype? This is like a chicken and egg situation. It feels like a chicken and egg situation. However, let me tell you that whenever an investor wants you to get more traction before you talk to them, it is basically to actually assess, what is your approach in the next 3 to 6 months. By all means, you should go back and try and come back to this person after 3 months, maybe 6 months, with more and more traction. Yes, for making a prototype, you will have to find some source of capital. My suggestion is, it is not going to be easy. So do whatever best you can from people who are willing to help. Maybe you could simply ask for a donation or ask for investments from people who are close to you and get the prototype out, because unless you get the prototype out, there'll be no traction. But my suggestion to all of you guys is, please do not wait for funding to happen. Funding is not an end result. It is not a validation. Please also make sure that you are not getting stopped by funding alone, because funding is not a problem today. It will continue to be a problem forever. If you do not start dealing with your business as most important, and funding is by the way just a means to get your business outcome, you will not be able to do a good job of what you are setting out to achieve. So please go ahead and work hard on whatever you can, limited resources that you can muster, and don't wait for the right thing to arrive to you. That's all. I think what we will end up doing is some of the questions we will answer in the comments themselves, so that all of you can take a good look at them. For now, that's all for me.
Thank you once again, Arpit. So we'll be back soon with our next Facebook Live session. Meanwhile, please visit our website. That's www.agni with a double I. So it's AGNII.gov.in. Follow us on Facebook, Twitter, and LinkedIn, and you will get updates about the industry as well as updates about our next Facebook Live. If you have any questions, write to us on agni.support@investindia.org.in. Thank you once again and have a good day.
See you, everyone.